tonight we'll be looking at the first quarter financial statements for fiscal year 2019. And you had the financials and the overview in your packets a couple weeks ago. We were scheduled for this 2 weeks ago. So the first fund that we'll look at, of course, is the general fund. And we always take a look at the balance sheet. We always discuss the cash balance. It's up $5.3 million compared to this same time last year. Analysis of that change indicates that last year's year-end results of $0.2 million is part of that. This year's revenues and expenditures, revenues are more, $6.7 million. Expenditures are more, $1.8 million, and I'll talk about those in more detail next. And then just normal fluctuations in our current assets and liabilities is what causes that cash balance to fluctuate. The next slide is our general fund revenues. We always show you this slide is the budget versus the actual so far year to date. And we always like to, of course, our ad valorem taxes are mostly collected through December and then again to the end of January before they're due. The property tax percent collected for the current taxes this year through December was 38.5%. Compared to last year at 53.2. That number can fluctuate substantially based on when the mortgage companies remit their payments. We fully anticipate the year-end collections to be on target once we hit the end of February, which we're here. So when I report March, we should be on track. The gross receipts tax revenue is down compared to last year just due to some timing differences of when those receipts come in. Our sales tax revenues are actually tracking slightly higher than the previous year through December, about $159,000 more. All other revenues are comparable to the prior year through the month of December. The general fund expenditures we show to you this way. This is the amount of budget spent so far this year. Of course, December is 25% of the fiscal year. As you can see, most areas are at or below that 25%. Parks and Recreation is below, mostly due to the timing of certain expenses like special events and the pools and other summer programs that will take place later in the year. Neighborhood Services is also below, and this was largely due to the timing of the abatement activity, which obviously happens later in the spring, summer, and fall. The non-departmental, we always talk about this each year, our bond principal and interest payments are due earlier in the year, so we fund those up ahead of time to be ready for those payments that come earlier in the year. So that's general fund expenditures. For the 4B fund, the cash balance was down $4 million. We have a receivable amount of $1.4 million. That's due to a couple of projects where we're expecting reimbursement from Dallas County for their participation in one of the grant programs. Of course, this project spending takes place over multiple years, so we're going to see that cash balance fluctuate. The project so far this year and under transportation is Town East Boulevard, Thomason Square, Sain Road, and Military Parkway Trail. In Parks and Recreations, it's operations, highway corridor maintenance, and the Westlake Tennis Center. This is through the first quarter of this year. In the Water Sewer Operating Fund, working capital, there's an increase over the prior year of $3.8 million. This number is largely due to the year-end results from last year, along with a slight increase in revenues in the current year of $848,000. The revenues are up due to the rate increase, and that is offset by a decrease in consumption of about 9.1%. The expenses, of course, are increased over the prior year due to increases from North Texas Municipal Water District for the pre-treated water and for the wastewater treatment cost. And so other than that, everything else is on track. We also have increased debt service as we issue more bonds to ramp up our maintenance of the system. That debt service number will increase as planned. This chart shows you the gallons of water billed, and you can see how October and November were quite a bit less than last year at the same time. December was slightly higher, but 9.1% reduction in consumption. That's due to the amount of rain that we had in the first quarter, and you'll see the effects of that in some of the other funds. So for the Drainage Utility District Fund, the working capital balance here decreased as compared to the prior year as planned for project spending. So we were anticipating that. The revenues are up over the prior year about 11%, and the expenses increased mostly in the expenses increased $51,000, and we've spent $625,000 so far towards the drainage projects. And this year, those projects include drainage related to Town East Boulevard, the Palos Verde Erosion Control Project, and then the South Mesquite Drainage Project, and then some other smaller drainage projects. The Municipal Airport Fund, there was an increase in working capital over last year of $100,000. The revenues, the hangar rentals are up slightly by 5.5%, and the fuel decreased substantially, and this was due to the airport runway rehab project. So the airport was basically shut down. They did have some smaller planes that could operate. The lease receipts were increased. This is an area where they've had a lot more attendance there, so that's gone up significantly. The expenditures, the fuel, of course, is down in relation to the fuel sales activity being down. The overall expenses are down as well, largely due to that rehab project going on at the airport. So they've had a net loss year to date, but that would be expected based on that project taking place, which was needed to make the airport even better going forward. We always show you the gallons of fuel sold. It's very different, of course, because of that project. This is the total, which includes both Jet A and Avgas. The next chart shows you the Jet A. This is the corporate activity, and it was reduced by 75%. Most of those larger planes could not land during the project. If you look at the Avgas, which is this chart, this is more of the recreational flying, and that decrease was around 30%. And I think Eric gave you some really good information in his quarterly report that was in your last council meeting packets. So the municipal golf course, the working capital increased slightly over the prior year, about $2,000. Overall, their revenues are down 19%, in rounds of golf down 21%, and this is due to the rain. So like I said, in the water sewer fund, less consumption. In the golf course, they're not going to be out there golfing in the rain. They had 15 rain days in the first quarter. So their expenditures are also down. They obviously had less watering cost and less staff there if the course is closed, or less activity. So they temper their expenditures as well. They have a net loss year to date of $34,000 as compared to $35,000 last year at this time. And it's typical that the golf course will run at a deficit in the winter months. Their busier season is toward the spring, summer, and fall. This shows you the rounds of golf. Again, those 2 months that had the heavy rain, December kind of pretty equal to last year. The group medical insurance fund here, the city's medical contributions increased $198,000 as compared to the prior year. You might recall that we had a 10% rate increase to the employer and employee side of the equation for the benefits here. The other revenues are on track with budget, and we are expecting, well, we did actually now at this point, we did get the check in after the last council meeting. We've received a $733,000 check from stop loss for large claims that have gone over the stop loss level. So that will help offset the expenditure items that you see here. The health claims are actually about $1.1 million more year to date this year than last year, but that stop loss offsets that. And then the HSA employer contribution is $983,000 more, but that's just timing of when the expense hit last year versus this year. That will level out according to budget. So that's on track with budget, just the timing. There is a net loss year to date of $2.1 million. That does not include that $733,000 check that we just received. So that will offset the deficit. This chart does show that the claims are tracking higher so far, those large claims. The fourth quarter of the calendar year, the claims are always higher because people have met their deductible and the plan has to kick in more. But these are in relation to those large claims, and like I said, we had that stop loss check to offset those. In the general liability fund, the revenues are up slightly, about 7%. Our legal expenses are less than the prior year due to activity we had then last year, but not this year at this time. And then the workers' comp and general liability claims are on track with budget. And I've talked about the fluctuation in numbers here, but they are on track. And the other expenses are on track with budget as well. There's a net income year to date of $85,000, so we are continuing to reduce that negative fund balance in the general liability fund. And our last fund is the hotel occupancy tax fund. The first quarter revenues are up 11.3% compared to the prior year. On the expenditure side, the Convention and Visitor Bureau expenditures are $106,000 more, but this is due to more activity. They're out there advertising, marketing, and promoting Mesquite tourism. And I think you saw Jessica's report, the CVB report, in your last meeting's packet as well. So there's good stuff going on there. They have net income year to date of $89,000. We always show you this chart, which is just the flow of the revenues, the fluctuations from year to year. This is a 3-year comparison of just the first quarter. And then now Jessica is reporting those other 2 charts that we were showing you. She's reporting that information in her quarterly report because she can do a lot more to explain the average room rates, and she's showing you the occupancy rates for the state and the region and for the Mesquite in her report. So we'll let her describe those there because she can go into a lot more detail in her report. So with that, I would answer any questions that you might have.
Thank you, Debbie, so much for your presentation tonight. Council, any questions or comments that you'd like to bring up at this time? Mr. Noche?
Thank you. Debbie, if you could, the chart that you showed us for the health claims and showing the trend lines on a 3-year comparison.
Yes.
So does that chart take into account the stop-loss check that we've received or not?
No, this is true expenditures. So there was one major claim and a couple other smaller ones that did go over the stop-loss. So this is the true number without netting the stop-loss.
Okay. Would you net that against that so that it would adjust that gap, or is it just something you do on paper and not affect the trend lines?
Well, I think it's important for you to see the claims cost, the raw claims cost, because the other 2 years don't include any stop loss either.
Okay.
So if we had
Fair
large claims,
I get it.
And so on the financials, though, you see on the revenue page of the financials, you would see that stop loss number separate as a revenue to offset them. So does that? I mean, we could show.
I mean,
it's a big difference.
It seems as though every time that we take a step forward, we take 3 steps back with the health claims.
I know.
And I can't, I'm trying to figure out some way for us to, I don't know if about get ahead, but not lose any more ground. And it seems as though where we are right now, we're going to lose tremendous ground this year.
Well, the stop loss, so it's early in the year. The first quarter is always the higher quarter for claims because, like I said, people have met their deductibles. So when we get to September, we won't have that for the fourth quarter of the calendar year. But I'm not giving up hope yet for this year because we did get the stop loss check. If there are any, so for those claims, we don't pay another dime. The stop loss covers it. So it just if there are any other large claims, but once we reach that stop loss maximum, they kick in. So the idea is to keep everybody healthy and it's hard to predict with health claims. It truly is. We've had a couple good years, really. But prior to 2017, I would say a year or two prior to that, we had some pretty rough years then as well, which kind of started us into the shape that we're in now, the shape that the fund balance is in. But
have we ever looked at the claims made by well, I'll talk to the city manager.
Yeah,
I just have some thoughts on some analysis that I'd like to see. So
yeah, and Rick, the HR director, he does a great job with his team monitoring with our health advisors. They do a great job monitoring, and I know he would alert us to things that we need to be informed about. But yeah, I'm sure that would be a great idea to reach out to Cliff, and then they could get you some more information. And we've made significant plan changes the last 3 years, significant. So we've done a lot to the plan, and then now we're addressing the rate side of the equation because, we had some room there. Our rates that we charge compared to other municipalities, there was room there to take care of that as well. Any other questions?
I did want to ask in regards to that runway rehab, are there any projections about our catching up with that finished and getting going? Projections that we're anticipating of catching up?
Mm-hmm. Eric can probably answer that question. I can give my 2 cents worth. Eric has done a great job since he's been here and did a lot last year to the bottom line. So I'm expecting great things from Eric.
Great. No pressure.
So with our budget offer this last year, we actually anticipated this loss, and we still projected that we would come in at about a $5,000 profit. Right now, we're actually trending towards that mark, if not looking like we are going to beat it.
Okay. And then the rehab is complete?
Yes, sir.
Okay. And up and running?
Yes, sir.
All right. Thank you.
Thank you.
Any other comment, council? question. All right. Debbie, thank you so much for your presentation tonight.
You're
We
welcome.
appreciate you.